Welcome to Market Call. I'm Morella Fernandez. Jamie Murray with us on the show today. He's president of Murray Wealth Group. He's going to take your questions on North American equities. Here's how to reach us. Call us toll free, 1-855-326-6266. You can email us as well, marketcall@bnnbloomberg.ca. Thanks for coming in. Good to see you.
Thanks for having me.
We have a new AI deal between Tesla and Samsung, which is a boost for Samsung, $16.5 billion chip deal. So would you say AI is still at a very early stage of investment?
It's definitely still in, we think, the first half of it, how this is going to play out. I mean, we think this is a 2030 story, ultimately, where this is going. So we think there's line of sight for another good 3, 4, 5 years. This Tesla chip deal is just one other example of the need for huge computing power to run these big models. We're seeing efficiencies across many different types of industries pick up just from what we've seen so far with AI, and we think it's going to continue to improve from here. And we think this is going to be a big theme that's going to continue to dominate for the next few years. I'd
love to talk some more about efficiencies, but first I want to ask you, we've seen other companies hold back on some of the capital investment because of the uncertain times and the tariffs, and they want to see what happens there. But I guess AI-centric companies are just moving full forward?
Yeah, exactly. It's a very bifurcated market. We're seeing, some industries where tariffs and interest rates and inflation are still taking a bite out of earnings and profits, and it's a struggle for them. And then on the other side, there's this whole AI economy where it's just full force ahead, and tariffs, the higher inflation, interest rates aren't really slowing anything down. So companies in that area, we're continuing to lean into because they're doing really well.
What are the efficiencies you're seeing so far? And again, I realize we're at an early adoption stage and that maybe Canadian businesses aren't really embracing it as much as other countries.
Yeah, so I think, I know there's the deal between BCE and Cohere this morning where it was announced today that they were talking this and how they want to help out small, medium businesses. And I think that is something that's more of a later in the decade story, and deals like this are going to help accelerate that. But it really is these large companies that have the resources to hire in-house developers, build their own software, build their own platforms that are starting to benefit from this. And I think when you look at the S&P 500 and you see the top 50 companies in that index doing really well, profit margins are increasing. Those are the companies that can afford to really benefit from this today. And it's going to take a while for the second derivative of this to roll out, where the software providers for small and medium-sized businesses are now building these tools into their softwares and offering that. And that's how a small firm like Murray Wealth Group, that's where we are. We're waiting for our vendors to provide us with these AI tools, because we can all have a ChatGPT subscription and we're using that and leveraging that internally. But to build out AI agents or some tools that can let us leverage our enterprise data, that's where we have to rely on our vendors for that.
And I want to see how that rolls out, because I know the front-facing, public-facing agents, when they're using them, they're not really working that well. I can definitely see a lot of frustration for people trying to interact with them the way when, they first introduced voicemail, please tap this button, and you had to go through 5 different versions of that. So it'll be interesting to see how they roll it out for public use. Okay, we are going to line up some questions for Jamie Murray of Murray Wealth Group. He's taking your questions on North American equities. Here again is how to reach us. We're back in a moment. Welcome back. Jamie Murray is with us today. He is taking your calls on North American equities. Mike is on the line with his colleagues in Toronto. Hi, Mike.
Hi, I'd like to ask about Dental Corp. Do you think this has room to increase the dividend and maybe become more of a yield play?
Okay, good question. Let's turn that over to Jamie. What can you tell us about Dental Corp?
Yeah, so Dental Corp is a Canadian roll-up of dental practices. Nationally, I think it's the largest roll-up, so the largest provider of this service across the country. And it's a company that we've just recently been starting to accumulate in our Canadian funds. The dental industry is a very safe, conservative, low-growth industry, and Dental Corp is just here to bring some efficiencies and bring some scale to that. And as they roll up with these practices, we're hoping to see the cash flow grow about 10 to 15% annually. So it's a lot of leverage they use for these roll-ups. They did just recently introduce a dividend. It's a pretty low yield. I think it's just 1 or 1.5% maybe right now. So certainly I think they'll increase that over time. But right now, this is all just about restarting the organic growth. They brought the leverage down, and we just want to see them continue to accumulate practices and grow that cash flow base. And
this is a company that basically takes the backroom administrative work out of it for the doctors who are doing the work. Yeah, so a lot of the dentists will sell their practice to Dental Corp. They'll stay on for 5 years. They get shares and stock in Dental Corp. And they really just become an employee of the practice. And it's a very nice model. Like almost every service is gross margin build. So to Dental Corp, as long as the labor is generating positive revenue, then you're getting that scale and that efficiency, and Dental Corp can just leverage some corporate synergies to try and bring the efficiency a little bit higher. Got it. Okay. Let's go back to the phone lines. Gordon is on the line calling from Victoria, BC. Hi, Gordon.
Good morning. Keyera and its predecessor companies have basically been the arterial system of our northern BC Alberta gas fields for decades. Great yield, great history of dividend increases. They've just purchased major assets from Plains, which they say will be immediately accretive. LNG Canada has just started to ship. There are 2 more port facilities in the works, hopefully more after that. Is Keyera on the cusp of years of an opportunity explosion?
Okay, so a lot of people are taking a lot of enthusiasm from the LNG projects that have started up and are now moving stuff off the coast. How do you see someone like Keyera Corp sort of fitting into that? Natural gas liquids? Yeah, so as volumes grow of natural gas in Canada, Keyera is going to be one of the companies that benefit from their processing, and they separate the natural gas liquids from the natural gas. It's a very, it's a midstream company, so they take a fee for this. There's a little bit of price exposure that they take, but it's mostly a fixed fee for service, stable cash flow business. And as Gordon alluded to, they did do a large acquisition that still isn't closed yet, so it's going to take a while for the market to digest this acquisition, but it's going to set the company up for another decade of growth, we think. And so Keyera is not one that we currently own in our income fund. We own a couple other midstream companies in Canada, but we do own some in some client accounts. So we like it, and I'd agree. I think that's a great deal, and I think it's got a great future, and just like the rest of the midstream sector in Canada. What about pricing? Some are saying the pricing has to come up for this to really be beneficial for investors. Yeah, and so that's on the natural gas liquid side. We're seeing some like propane and butane, some of these NGLs that they extract. The prices are really low, so they're not making a huge spread when they strip those out and sell them. That would certainly help give some juice to the company, but ultimately it's about growing that volume and growing their asset base and continue to process more and more natural gas, and that's what we see as these LNG projects come on in Canada. Got it. Okay, let's go back to the phone lines. Elliot is on the line from Hamilton, Ontario. Hi, Elliot.
Good afternoon. Please, Chubb Limited, the world's #1 PNC insurer. Unfortunately, for months now, lower highs, lower lows. 2 recent TA or technical analysts on BNN said if it goes below 270 for 3 days, abandon it. Well, that's where we are. Please, what's going on with Chubb? Thank you. Okay, we'll have a discussion about Chubb. What are your thoughts on it? Yeah, so Chubb, it's not a company that we currently own. We don't really own anything in the P&C insurance space right now. The only stock in the insurance industry we own is Aon, and so that's an insurance broker. We like the brokers a little bit more. They just take, it's more of a labor play on the insurance industry. You're just taking a margin on every insurance policy and advising companies how to structure their insurance programs. So we haven't really been in the P&C market. There's a little bit of softness coming in after years of hard pricing, and so I think that's why if you look at the long-term chart, Chubb's been a great performer. Just a little bit of a short-term struggle with some of these pricing challenges. I think if you have a long-term view, which is how we look at stocks, Chubb it's one of the top in the insurance industry, and we'd be looking to accumulate it when it falls below or when it dips down rather than sell it. So that's how we look at a company like Chubb. Yeah, I guess the investors are looking at it. It was at 302 roughly March and sort of April, and then down to 266.50. Has them wondering, but you say you'd hold on to it for a longer term.
Yeah, if we owned it, it's the type of company that we would tend to own for a long term. And we'd be looking at a company like Chubb in these dips to establish an entry point rather than sell an existing position.
Got it. Okay, we are going to take a quick break. Jamie Murray of Murray Wealth Group taking your questions on North American equities. We're back in a moment. Stay tuned. Welcome back, and thanks for joining us. Let's go to another caller on the line. John is calling us from London, Ontario, with a question for Jamie. Hi, John.
Hi, Marilla. Thanks for taking my call. Jamie, 4 Mag 7 stocks are reporting this week, 2 M's and 2 A's. Do you see any shining star among them, and which of these is most likely to ignite my bones? Thanks very much.
Ignite his bones. I'm not sure many will ignite his bones necessarily. However, do you separate the Mag 7 now? Some people do.
Yeah, we certainly do. So we've, out of the Mag 7, we like the ones that we own in our global equity fund are Amazon, Microsoft, Meta, and Alphabet. So we've seen Alphabet report. I thought a very strong report last week, and now this week, the one I'm most looking forward to, I think, is Amazon. So if I was, like I said, we own all of them. We own all of them in size. But if I was putting money to work today, Amazon's probably the one I'm looking at. And that's because Amazon has this long tailwind, I think, of gross margin expansion. And so as a company that historically has had very low profit margins from its e-commerce and retail division, you know, we think now that they're layering advertising, AWS continues to grow, we think there's a very long margin tailwind for Amazon. Whereas, you know, these other companies all have extremely high profit margins today, where Amazon has this, we think, a long-term catch-up. It's trading at the same PE multiple as Microsoft. Meta and Alphabet are a little bit cheaper on a price-earnings multiple, but you get a little bit more volatility in the earnings with a very advertising-heavy focus. So, you know, Amazon's the one that I'm most looking forward to. Obviously, we don't just play earnings results, and I don't really know if they're going to beat or miss this quarter, but certainly a name that I'd be looking to put money to work to.
Okay, today. So if you had to decide where to put some money right now, that's where you'd put it.
For sure.
Got it. Okay. John, I hope that helps you out. We're going to move on to Michelle calling us from Vancouver, BC. Hi, Michelle.
Hi, Marella. Can I get Jamie's analysis on United Health? Where do you see it going, and should I keep holding it long term? Thanks for taking my question. Okay,
so United Health has had a number of issues that it has had to try and work out from. It is still dragging compared to what it used to be, that 282.63 today. But of course, again, if you want to just go through some of the challenges it's faced in the last year and a half.
Sure. So United Health, we do own this in our global equity fund. Obviously, it's been a very tough year. So they're facing several challenges, and in terms of breaking them down, I mean, it's a lot of challenges on their patients. Turned out to be more ill than they expected. So when you price out the insurance, it turns out they needed more services than you expected. Now, is that due to there's some thought that might be due to GLP-1s, where people take a GLP, they get healthier for a short term, and then they stop taking them, and then some of these issues come back. So that's one thing I'm listening for on the call tomorrow, because it's tomorrow morning they're going to report. They pulled their guidance because of this, so we don't really know where their EPS guidance is going to land, and so that's sort of the other clearing event, we think. The new CEO who's come back, who was our CEO from about 6-7 years ago, is now back running the company, and he's going to put in a new guidance number tomorrow, and that's going to give us a new baseline for, okay, here's where we are in 2025, and now what can we grow? How can we grow from this level going forward? And so that's going to be a clearing event, I think, for the stock. And you know, when that comes in, you know, I think investors will start to relook at United Health as a long again.
So because we're in a situation where we're going to get some information from them, obviously the stock is half of what it used to be even a few months ago. Would you advise people to sort of wait to hear what comes out of that information session and then make a decision, or make a decision before that?
I certainly think it's going to be a volatile opening tomorrow. So you could get, for sure, it could be a 10% down.
Go anywhere, yeah.
Could be 10% up. But I think, yeah, maybe after that, then you're going to have a nice baseline to grow further. Now, there are some, you know, DOJ investigations as well into United Health, which is, you know, clearly a concern. But this is a company that, you know, we believe has gone through these investigations. It's a heavily regulated industry and a systematically important company. It's the largest healthcare company in the United States. So, you know, we think you're balancing the risk and reward. We think that there is a long-term upside in the name where it is today.
Got it. Okay, let's go back to the phone lines. Jacques is on the line. He's calling us today from Toronto. Hi, Jacques.
Hello, yes, good afternoon to both of you. Mr. Murray, I'd like to ask you about the Alimentation Couche-Tard. Is it something that they should keep or sell? Because I thought after unhooking themselves from 7-Eleven will be a much better company. It will move up a little bit, but nothing is happening. It keeps on going down. Shall I keep it or sell it? Thank you very much and have a nice afternoon.
Okay, thank you for the question. And to give viewers just a bit of the background, some of you already know they were going after the 7-Eleven U.S., I guess, stores, but the Japanese company that has them was not really wanting to sell. So after pursuing it for a while, they dropped it. And I guess that's what he's referring to. Jacques is saying, I thought they'd get more of a bump. They got a bit of a bump.
Yeah, there's a good pop. They announced a large share buyback as well. I think at the top of the show when I said there are some companies that are benefiting from the AI and then some that aren't and are dealing with inflation and interest rates and a sluggish economy in some ways, I think that's just Couche-Tard to a T today. They're just dealing with a consumer, particularly a low to medium consumer that is maybe buying less convenience store, whether it's fast food, cigarettes, gasoline, just a few more challenges, and that's just creating a sluggish environment. I mean, ultimately, Couche-Tard is about that consolidation and the whole story of they started with one convenience store and now they own, I think, like 16,000 or something. So that's where you want to see them continue to acquire and bring their best practices to this industry. So I think you can hold on to it for that. It's not one that we've owned, though, recently in our funds.
Got it. Okay, let's get one more caller in before a break. Kevin is on the line from Toronto. Hi, Kevin.
Hi, yeah, thank you very much for taking my call. Jamie, I'm looking at Interfor with the tariff date looming August 1st. Do you see Interfor, is there any room for it to move? Is it something you would hold or should I hang off? Thank you.
Okay, so they do timber and lumber, which is in the line of sight for Donald Trump.
Yeah, I mean, the lumber sector in Canada has been, always in the line of sight for the last decade. There's been tariffs and levies put on softwood lumber, and the U.S. government's been holding back, payments from shipments coming in that are owed back to the Canadian forestry sector. So it's been a really tough sector. Then you're dealing with slow housing markets on top of that. Mm-hmm. That's just depressed the lumber price for the last 2-3 years. So Interfor, it's not a name that we've looked at. We haven't really owned any of the forestry producers. The one name in the sector that we do like, that we own in our income fund, is a company called Doman Building Materials. Okay. And Doman's similar to a midstream company in the oil and gas sector. Doman, it's more of a processor of lumber. So they own lumber and timber yards where they'll take the lumber in and they'll process it into value-added products, and then they distribute it to Lowe's is one of their big customers down in the States. They've been buying these up, and so you get a nice yield with Doman, a little bit more stability. Still get some upside if lumber prices move up, and then you get a nice dividend. Like I said, that's really the reason why we own it.
Okay, so a good one to consider if you want to go that way. We are going to take a quick break. When we come back, Jamie's past picks. Back in a moment. Welcome back, and thanks for joining us. We're going to take a look at past picks from Jamie. August 27th of last year is the time period, and at the time he chose Lululemon, big Canadian company that does activewear. At the time, it was $271.18 US, now down to $217.80. Again, US, so a 20% return drop, total return drop of 20%. Was Lululemon caught up at all in the tariff noise of exports from Asia, or what else has been going on? I know there's a lot more competition in the space than there used to be.
Yeah, for sure. So, I mean, first and foremost, if you look at the chart, we actually sold our Lululemon in December 2024 around $400 a share. So when we bought it, we were buying it for a long-term view that it could be at $270. We think it could be worth $350 to $400, and it got there faster than we imagined. But in this type of company, we will take our profits when they come. And so we did sell our Lululemon then. And we've been looking at whether we want to reestablish the position, obviously down from where we bought it last summer. And You're right. There is some tariff noise, so they're caught up in the tariffs, just like many other fashion companies in North America. But the bigger concern that why we haven't reestablished the position is their same-store sales in the United States. Last year it was flat, and they had many different reasons. The colors in our assortment isn't right.
They didn't have the right
inventory, but
style choices.
We had the breeze-through pants, I forget what they're called, had a little fashion mishap. So some short-term issues, but fast forward a year later, they should have fixed these, and their same-store sales was still 0% in the United States. So it's 2 years now where they haven't really grown on a per-store basis. And we've seen the multiple now reflect that. And so it's trading at 14 times PE. This used to be a company that traded over 30 times. So it's starting to get interesting again at 14 because now it's just almost being valued as any old mall retailer in the United States. So I think we're starting to look harder at it at this price. But yeah, certainly we want to see that U.S. business start to grow again before we get too excited about it.
Got it. Okay, let's get to your next topic from August of last year, Airbus. At the time, it was $39.28 US, up to $52.03 at this point. So a 32% return and a total return of 35%. What's been going well for them?
Yeah, there's just an insatiable demand globally for new aircraft. It's a duopoly. There's Boeing and Airbus. We know Boeing's had issues on the delivery side, and over the years they've been limited by the technical issues. The government's put caps on how much they can produce. Airbus has also been limited, but just by the supply chain. So it's just a matter of how can we get more and more airplanes out. Right now, the big shortage is engines. They have, I think, 50 to 60 planes sitting ready and waiting to be delivered. They just need to put the engines on them. So there's an engine shortage that's affecting Airbus, but it really is just that there's this huge backlog, a decade of airplanes, and if they can continue to increase the production, the earnings and the cash flow will continue to increase. So we still own it. It's a core holding for us. We have been trimming it a little bit, up 35% in the last year. We're finding some better opportunities, but it's still a name that we have, I think, a 4.5% weight in our portfolio.
Got it. Okay, let's go to your next past pick at the time was Northwest Healthcare REIT, 522 when you recommended it, now down to 481, so an 8% drop return and a total return of under or 1% drop return. So what has been happening? I know that the REITs in general, there hasn't been sort of as much excitement about them, and I'm wondering, is healthcare on its own as well, or is it just sort of caught up in the whole space?
Yeah, I think it's just caught up in the whole space. We've seen interest rates in Canada and the U.S. kind of back up in the last few weeks, and so that's taken some of the air out of these interest rate sensitive sectors. I mean, if you look at the chart, it's pretty much, aside from a little pop in October, traded pretty flat over the last year. We like it for it's got a 7.5% dividend yield. We think healthcare is a very defensive space, so where we're seeing lots of Canadian multifamily, we're seeing population estimates come down, we're seeing rent prices start to fall. Northwest doesn't have that problem. They have very long-term leases with rent escalators built in. This company has had issues in the past, but they've fixed those. The debt is down, the cash flow is up, the payout ratio is very sustainable. And they just hired a new CEO. That was one of the things investors are waiting for, is you have an interim CEO who's going to be the permanent CEO. He just started about 3 or 4 weeks ago on July 2nd, and so this earnings call is going to be his first earnings call to deliver his new message for the future of Northwest Healthcare. So we're looking forward to hearing that to see the future direction.
Got it. Okay, we're going to leave it there for now. As we move on, we'll line up more of your phone calls for Jamie when we come back. Stay tuned. Welcome back, and thanks again for joining us. Bill's on the line from Toronto with a question for Jamie. Hi, Bill.
Hi there. My question is on Pembina Pipelines. Back in April, it traded at $58. It dropped quickly down to $50. I believe that could have been because of the dividend payout. It's bounced around a little bit since then. In the last month, a lot of market call guests have recommended it as their top pick, but it just doesn't seem to be moving. So what's the deal here? Do you just buy it and collect a dividend, or is there room for appreciation on the price of the stock? Thanks very much. I'll hang up and I'll listen to your answer.
Okay, so we'll have a look at Pembina. We're pulling up the chart right now. It is at 50-50. It was at 60, I guess, earlier in the year. Is this something you would dip into at this price and hold?
Yeah, definitely. We own Pembina in our dividend income fund, and we've been adding to it as well recently. That 5.5% yield is very safe and stable. I think it's just similar to Keyera. We talked about earlier, natural gas liquids prices are weak. That's depressing some segment of their profitability. They also had a big toll dispute on their big Alliance pipeline that just was resolved on the weekend to pretty favorable terms, I think, for all parties involved, including Pembina. And so I think it is ready to start to take a new leg higher. Now, I mean, this is a company that's going to benefit, again, from those growing volumes. And they do have some ownership in a small LNG project as well of their own out in BC. So lots of long-term drivers. But I think this is really one that you want to collect for the dividend and just hold it. And they will increase it every year. And so that's why we hold it.
I guess he's wondering if it's going to experience growth sooner than later, but it's hard to tell with some of the energy players because you don't know when it's pop. And as you mentioned, natural gas is priced low at this point.
Yeah, for sure. And I mean, we're hoping it starts, the share price rises sooner than later as well. But, at the end of the day, it's just all about waiting for the market to start to recognize some of that value and collect that dividend in the interim. Okay, so buy it, hold on to it, try and forget it's there, and then at some point, hopefully reap the reward. For sure. Got it. Let's go to Faisal on the line from Toronto with his question. Hi, Faisal.
Hi, good afternoon, Mirella. Good afternoon, Jamie.
Hi.
My question is on Hammond Power. It had a very precipitous fall on Friday, notwithstanding they beat on revenue. However, expenses were higher due to input costs and I believe the rollout of the new plant in Mexico. That being said, Jamie, would this be something would you be stepping in now, or does it have further downside? Okay. If I can get your thoughts, please. Thank you.
Thanks for the question. So it looks like it was at about 139 or 140 before the drop he mentioned, now down to 114. What actually happened here?
Yeah, so they reported the results Thursday after the market closed, and as Faisal said, a little bit weak on the gross margin side, and that their backlog decreased a little bit as well, and so that led to a short-term drop in the stock. But I mean, this is a company that we think, if you believe in, again, the AI trade and that we're going to be short electricity and there's going to be huge demand for new data centers to the end of the decade, Hammond will continue to benefit from that. We just bought this company for the first time in April of this year when everything kind of fell in that tariff noise, and so we'll be looking to accumulate on this pullback. I don't think it's a thesis breaker or any sort of long-term factor. If that's why you own the stock, you're still owning it for that electrification demand. They have a new plant coming up in Mexico that's going to be very efficient and allow them to open up new markets in terms of custom building electrical products for their customers. So it's a company that it's not too expensive. I think it just trades at around 10 or 11 times EBITDA, below where most of its peers trade. And so, yeah, this is one that with a long-term outlook, I'd be buying on this dip.
You're happy to hold it. Okay. Let's go to Steve, who's calling from Vaughan, Ontario. Hi, Steve.
Hi. Good afternoon. Thank you for taking my call. I was just wondering about Mr. Murray's opinion on Pfizer. I know that they've sort of shifted. There's more of a focus on oncology as opposed to vaccines. Yet the stock seems to be stagnating. I just wanted to see what Mr. Murray thought about holding it or perhaps selling it and moving on to something else. Thank you very much.
So pharmaceuticals generally seems to have been depressed. And I know some people are hoping that they've got something in the pipeline that'll help to pop down the line. What do you think of this particular company, Pfizer, and what it has in the works?
Yeah, so Pfizer, it's a company that we, again, hold in our dividend income fund. And for that exact reason, we hold it. We think that dividend's safe. It's a 6.5% yield, I believe, where it's trading today. And they have this large pipeline of new drugs, and you're just hoping that enough of them hit. Ultimately, that's a very hard game to play, trying to predict which ones do. So Pfizer has a very broad portfolio. We think the stock's washed out and that there will be some successes in this portfolio that will drive the stock to $30 and hopefully beyond. But definitely that's what we need to see to get more excited. But in the interim, that dividend, we think they do have enough drugs that have a long enough patent life that you're going to see consistent cash flow. They'll be able to pay that dividend, and it gives you that free optionality that we don't think is really priced in right now.
Got it. Okay, let's get to one more call before break. Patrick's on the line from Winnipeg. Hi, Patrick.
Hello.
What's your question?
And I would like your opinion for the HWM for the next 1 to 3 years. And I will hang up and listen to it.
Okay, Howmet Aerospace?
Yeah, so Howmet is another company involved in the aerospace market where they make parts. They make lots of these parts for the engines that are still in short supply, and there's obviously huge demand as we were talking. Airbus is literally clamoring to get more and more of these engines. And so it's just in a really sweet spot of its product cycle. It's not one that we've owned, but I mean, if you look at the stock, it's been a huge performer over the last 2-3 years. It is a very expensive stock, though, as well. So you're really just banking on that demand continuing to be there, and that I think it would be sensitive to any sort of slowdown that we do see, even just in the global aviation market. If we see an economic slowdown, that might lead to some slowdown in delivery or demand for some of these engines. But ultimately, I mean, I think if you're bullish on the long-term aerospace market, then I mean, Howmet's a great way to play that. It's just a little bit too expensive for our blood.
Okay, and just because we don't have a chart, I'm just going to let people know it was at the end of last year, 110, 109.37, up to 187 so far this year. Okay, we're going to take a quick break. Back with Jamie Murray in a moment. Stay tuned. Welcome back. Let's go to Jim on the line from Peace River in Alberta with his question today. Hi, Jim.
How you doing?
Good, thanks. What's your question?
Synovus. They just recently announced a friendly takeover of MEG. How will that affect the share price, and do you think it'll go through first, and how will that affect the share price in the company? Thank you very much.
Okay, so they're putting together I guess, an offer after Strathcona Resources tried to take over. What's your take on first of all, whether that deal will happen and if it would be good for MEG?
Yeah, so I think right now it's still a bit of in the rumor speculation phase that they're putting together an offer. I don't think they've officially announced or put the bid forward, but I mean, it was always sort of the white knight in waiting. It seems to have the best overlap in terms of where their oil sands operations are, and it would be the most logical buyer, at least out of the big oil sands companies. Suncor, CNQ, Imperial, Synovus is the most logical. So we'll see if that actually comes to fruition. I think, if it does get announced, you might see Synovus stock fall 3 or 4%. Potentially when they announce it. Sometimes that just happens with the buyer stock sells off. In this case, MEG stock would rise. But ultimately, I mean, I think Synovus, it comes down to they have a great upstream business. So the oil sands business is very, very strong. They did a great investor day a couple of weeks ago talking about all these new projects that have to come on stream over the next couple of years. They also have a nice position in that Montney Duvernay as well. That's a lot of growth in Saskatchewan as well. So it's got a great upstream business. The problem with Synovus has always just been its downstream, so it's refinery business. It owns some old refineries in the United States that always, every quarter, every year, have an issue and lead to a big miss in their cash flow, or they have to spend a bunch of money turning one around. So that's really what Synovus needs to get right to make the stock work from here. But with that said, I mean, it's one of the cheapest oil stocks in Canada. And particularly when you compare it against the Suncors and CNQs, it trades at almost half the valuations of those companies. So it is an interesting one. If they can get the downstream business right, I think there could be a lot of upside in the name, whether they buy MEG or not.
Yeah, we're still not sure where that's going, if it's going. All right, let's go to another caller. John is on the line from Red Deer, Alberta, with a question. Hi, John. John, are you still there? Okay, we may have lost John, but very similar to what we were talking about just now. His question was about Whitecap, which, of course, went through a merger deal as well. Forward looking for Whitecap, because it did take that hit, right, as the one who was buying. And I haven't looked if it's going to bounce back. We'll pull up the line chart in a moment.
Yeah, well, Whitecap, if you pull up the chart, it's had a huge recovery, particularly in the last week. They announced their earnings last Wednesday, and I think it was one of the best earnings reports we've seen, particularly out of Whitecap, but maybe out of any Canadian oil company in the last 2 or 3 years. They blew away on production. Their CapEx was lower, and so just a great report all around. And this is a name we do own in our income growth fund in our Canadian portfolios. We've always liked what they're building. They've done a couple of big deals that the street has had some pushback on, but now they're in a great position with a very long-term inventory base. They're focused on the Montney and Duvernay, which are the big, deep oil and gas fields out in northwestern Alberta. And the dividends, the other question, is it sustainable? And I think this quarter, made it a resounding yes. They can keep this dividend at around 7%, continue to grow their production, and they'll bring the debt down as well. And so this is a name that we'll continue to hold. You do get that exposure to both oil and gas with Whitecap, and so it's a great holding, particularly now with the combination, one of the best land packages, we think, in Western Canada.
Got it. Okay, good to know. Let's get to an email then. This email coming in from Yasmin. She says, may I please have your opinion on the Bank of Nova Scotia? Let me pull up that chart right now as we talk about the banks. Where does the Scotiabank fall compared to your read on other banks?
Yeah, Scotia, we like Scotia. We have a pretty significant position in our income growth fund. It is the highest yielding bank, I believe, out of the big 5 or big 6, if you want to include National Bank. Dividends over 5.5%. So a nice yield that we think is going to be sustainable, and they're starting to grow it again. So that's nice to see. And this is it's really a longer term turnaround play. They brought in the CEO from Finning, Scott Thompson, who was on the board, and then they brought him in to be CEO about 2 or 3 years ago. So it's been a couple of years in the work, but we just think he's doing a great job with the turnaround. The investor messaging's better, the operational focus seems stronger, and we think it can sort of regain its crown as one of the gold standards in Canadian banking. When we look back, 5 years from now, we think that's how it'll be viewed. And so, this is it's a longer term stock. Again, collect your 5.5% dividend and let management do its thing. But ultimately, it's almost at its high from 3 years ago, and we think it'll eventually surpass that and continue to move to all-time highs.
Yeah, it started to move down sort of end of last year, sort of this year, down to, of course, the April low. What was happening around that time that led to this fall?
Yeah, I mean, certainly the tariff noise in Canada through the winter and into April when Liberation Day happened and global stocks all crashed in early April. Bank of Nova Scotia wasn't immune to that, but we've seen a strong recovery from most Canadian banks. I believe all of them are kind of moving back to their highs from last year and even beyond that in some cases. And we think Scotia, it'll get there as well within a few months.
Got it. Okay, let's move on to another email. This one is from Matthew. He says, may I please have your guest's opinion on NFI? They make buses. They're out of Winnipeg. And I know there was a shortage at one point of seating or something that they were waiting on. Has that reconciled?
Yeah, so not unlike Airbus, NFI also had supply shortages. That meant they couldn't deliver their buses. And yeah, seating was one of the most recent example. But in 2021, 22, there was a whole litany of them. But those shortages are getting better. NFI did have a little bit bigger financing concerns than like a company like Airbus. That's a global behemoth. But NFI did have some liquidity challenges because, again, the buses were pretty much finished and piling up in the parking lot outside because they were missing just a few components to then deliver them to their customers. But those shortages are abating. They just, I saw this morning, got another big order from, I think, Toronto for some new buses. So a great backlog. Again, it's just about increasing supply, which seems like the management team's doing. And this is one that we own in our Canadian portfolios, and we think it's got more upside as well as these buses get delivered.
And they do electric buses?
Yeah, they do all types of buses. They do it, but the big, recently it's been the electric buses that the cities have been ordering. But they can make any type of combustion engine. But the electric buses are nice. They're a little bit higher premium price, a little bit more gross margin. So they make a little bit more money on the electric buses.
Got it. Okay, let's get to one more email before we have to take a break. From Alex, who says, may I have your guest views on Evertz? Is it Evertz Technologies?
Evertz,
thank you.
Yeah, hard E.
Tell me about them.
Evertz, it's a company. It's very tightly controlled. The two founders, I think, own still about half of the company. It's in the telecommunication space, and they make equipment, hardware, and software that allow for broadcasting, whether it be from live in studio. I'm sure like Bell probably is a large customer of Evertz and uses some of their hardware and software to deliver both the TV streaming over the internet. And so they just have this nice niche in this market. They're big investors in new technologies, and every year it pays a 6% yield, and then every 3 or 4 years they typically pay out a nice special dividend that can be as high as 10% of the market cap.
Nice.
So it's a highly cash flowing business, and a leader in the streaming and telecom space. So it's one that we like for that reason.
Got it. Okay, we are going to take a quick break. That's all the time we have for phone calls and emails. But Jamie has new top picks. He'll share those when we come back. Join us tomorrow for Market Call. Paul McDonald on the show. He's Chief Investment Officer and Portfolio Manager at Harvest Portfolios Group. He'll take your questions on U.S. healthcare stocks. And if you miss an episode of Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for Jamie to share his new top picks. We're starting with Broadcom on the NASDAQ. AVGO is the stock ticker. What do you like about Broadcom?
So when we're talking about we like the AI market, this is our pick to lean into that. So Broadcom, the stock's been on a tear. It's all about selling these custom AI chips to companies like Google and Meta. As opposed, it gives them another option other than NVIDIA. And so Broadcom helps these companies build custom chips to do, very specific applications. But when you're Google and you want to build a recommendation algorithm for YouTube, that's a very big engine you need to build. And so Broadcom helps companies build that. We just saw Google raise their CapEx last week. We're probably going to see Meta do that. And they're both talking about spending more money next year. And so that's just all good news to Broadcom. It's not a cheap stock. It trades about 37 times earnings, but it's a very ruthless, efficient company. So they manage margins very tightly. It's 60% EBITDA margins. They don't have to spend a lot of CapEx to grow. So this is a company that we think is going to continue to benefit just from this AI trade.
Got it. Okay, that's Broadcom. Let's get to your next pick, which is Qualcomm. Again, on the NASDAQ, QCOM. And they're, a chip maker, again, for smartphones. But you had mentioned, we were talking about this at the break, that Apple is they're losing Apple's business.
Yeah, so
but you still like them.
That's sort of the elephant in the room, is that they make a Wi-Fi chip for the iPhone that Apple's bringing in-house. And so that business that they have on the iPhone, it's been a very contentious relationship between Qualcomm and Apple over the years. They've sued each other. They've fought. And so this business is finally moving away from Qualcomm, and Qualcomm won't have any exposure to Apple. But that's the downside. But the upside now is all these other great things going on. Investors can start to focus. So they still have a great business in the Android smartphone market. It's a much bigger business than their Apple business.
Really?
Yeah, and so they make multiple softwares and chips that go into your typical Android phone.
So they offer more to Android, and therefore it's a bigger part of their business.
Yeah, for sure. And as that business continues to grow, that'll help them. But then they've built out a lot of businesses in automotive. So the new BMW new class cars BMW's next generation electric vehicle is going to rely heavily on Qualcomm's vehicle chips and platform. They also make chips that go into the Meta Ray-Ban glasses to do the AR. They're getting into data centers. They're building chips for laptops that can help the battery last like 1 to 2 days instead of 4 to 6 hours. Mm-hmm. So we think this is, in 2 to 3 years, as the world continues to move more and more into AI, we're going to need better and better hardware, and Qualcomm's going to be a company that's going to help enable that.
Got it. Is there pickup for you mentioned the glasses that people, they've been trying to market, but I haven't seen a lot of pickup personally. I'm just wondering what your take is on that.
Yeah, I think the glasses have been pretty successful. We're seeing, Meta talk positively about sales. I know a few people now who are using them, and they're pretty interesting, and it's just one sort of leg to the stool of Qualcomm. Mm-hmm. But it trades at 12 times PE. That's the other thing, where it's a big discount to the market. And so we think over time you'll get a re-rate in the price earnings multiple as well.
Got it. Let's get to your third pick then, which is Chemtrade. They are a chemical company, obviously. They have a new CEO. What do you think of the new CEO?
Yeah, so new CEO started 3 or 4 years ago, so not too new, but just
newish.
It's been newish. It's been a new sort of operating paradigm since Scott Rook took over as CEO a few years ago. And so Chemtrade longer terms had some issues going back to the 2015s, 2020s with some acquisitions. We see a much cleaner operating company. I don't think the market's giving credit for. And so it's a specialty chemical company. They just have some good assets. And the big thing is just the valuation is so cheap that, you can almost, on the back of a napkin, get to a 15% return very easily. And that's through a 6.5% dividend. They have an active share buyback that's going to buy back about 5% of the stock every year. So that gets you to an 11 to 12% return just from that. And then there's growth on top of that. They're investing heavily in their water business, which is a great business, treating wastewater and municipal water, very stable. And then the rest of their assets are in low-cost jurisdictions like in Manitoba and British Columbia. They rely on hydroelectric power, whereas their competitors in Europe are dealing with much higher power prices. So it's a company that if it traded at an 8 times EV, but the multiple we're probably not out here talking about as a top pick, but given where it's trading, I think you can underwrite like a 15% annual return for the next 3 or 4 years in Chemtrade.
Got it. Okay, so Chemtrade, CHE on the TSX, CHE-UN. Jamie, we've got to leave it there. We're out of time, but thank you for coming in. We'll see you again soon. Have a good summer until we see you again. And thanks for joining us here on Market Call. We'll take a look at the markets as we head to a break, and we'll see you again tomorrow.